just almost got done yesterday, and we had Cox and Kings that reported a rather a mixed quarter, if you'd like to call it, with a weak top-line growth and stable margins. We have Peter Khedekar, the CEO of the company, who joins us. Hi, Mr. Khedekar. Thanks so much, sir, for joining in today. Well, prima facie, it appears that there's a dip of 20% on the top line. Is that comparable? Was there any kind of subsidy that you sold on a like-to-like basis? What should that top-line number look like?
You've hit the nail on the head, because last year we still had two subsidiaries in the group, which were Late Rooms and Superbreak, which we finally sold in the final quarter of last year. So like for like, it looks far better. Actually, the top line was pretty flat for the quarter if it was like for like. In fact, the 9-month results last year were shade over 6,000 crores, and this year has been again a shade over 6,000 crores. So it's not a real correct like-for-like comparison, but in like-for-like terms, we've done a pretty flat year for this quarter.
Okay, so like-to-like, the revenues have been on the flatter side. What was the impact at the margin level? And also, if you exclude the Forex element, if you could tell us what the margins are and what is the sustainable margins going ahead?
So I think that if you see the EBITDA for the quarter, actually last year we made 115 crores, and this year we made 117 crores from the existing operations, excluding any Forex impact. And the margins, actually our EBITDA margins, if you see, have actually sustained or slightly gone up, because some of the lesser quality businesses were sold in the last quarter. That's Late Rooms and Superbreak of last year. Going forward, I think that in constant currency terms, we've done pretty well. We've actually seen an 8% growth in our education business over last year. And this we think is possibly going to, it's really related to the pound, because about 40% of our incomes comes from is pound income, GB pound income. And we believe that the pound has probably seen, it's not going to deteriorate much further. If at all, we should see some improvement in the coming quarters. So, we are guiding our education business going forward at around, say around between 5 and 8% growth in the coming years. However, if you look at the India business, while the last quarter was slightly weaker than we anticipated, but we think that the demonetization effect should really benefit us going forward, and we are seeing pretty robust sales for this quarter as well as the main season in terms of advanced sales.
All right, Mr. Khedekar, we'll get back to your operational performance. I wanted to ask you, what about your debt? What does it stand at? Because your finance cost has gone down drastically. That's point number one. And point number two, I wanted to know, what is the ROC you're working with? And also, if you could give us some kind of numbers in terms of a free cash flow.
Okay, so actually this particular quarter, we are at around 3,400 crores of debt. We've actually sitting on slightly more cash, around 1,700 crores of cash, because we collect deposits from our clients, especially in education at this time. So while we benefited from the pound depreciating, we also have dollar debt. So overall, we only reduced our gross debt by around 30 crores this quarter. So this quarter, we generated as a company probably around 35 crores of free cash. And we are still maintaining our target that by year end, we should achieve our target of between 400 to 500 crores of debt coming down, as opposed to last year in March, where we were at 4,100 plus crores. So we've seen a significant impact of debt coming down. In fact, in this quarter, our interest has come down by almost 30%.
Okay, that's about the debt. Could you, Peter, if you could just tell us what the outlook is looking like? You spoke about the education business, but that's about 30-35% of your revenues. If you could tell us how the situation is looking for the India leisure business, the international leisure business, as well as the Meninger hotel chain in Europe. What should we expect going ahead for the rest of the three verticals?
So I think that the most positive is for India, because what we're already seeing is a positive effect from the demonetization. We're seeing that a lot of the smaller players, the fragmented players, are being squeezed out as more and more of the travel disposable spend is coming to organized players like ourselves or national players like ourselves, who have, are operating in sort of the white money economy. And we are still guiding that going forwards, we should see a 15 to 20% growth long term in our India business. So that is looking very strong. And we are seeing robust sales both in this quarter as well as our future bookings. Our main season starts for the first quarter next year in terms of outbound travel, and that is looking very strong. Meininger, already this year, it's performed reasonably well in spite of some setbacks like the Berlin attack and earlier in the year in Brussels. It still managed to outperform last year. And the good news is that we've taken our bed bank from 7,000 beds to 8,700 beds by the end of this quarter. And we've got build-outs that are planned that will take our beds out to 15,000 beds in 2 years from now. So it's a very aggressive growth for Meininger. On our international leisure, we see this as flat. While margins have dramatically jumped from around 29% last year to the low 40s this year in terms of gross operating margins, this is our one segment of the market that is high value, but it's not going to grow exponentially. So we're thinking if we do single-digit growth going forward, we'll be very happy with that. But the good news is the India business is a big driver for the whole group, and Meininger is also.
Well, in terms of Meininger, you were talking about 8,000 beds currently. What is the current occupancy? And for you to go from 8,000 beds to 15,000 beds, how are you going to do that? It's going to come at a cost. So how do you manage to fund that?
Well, the great thing is that with Meininger, it's a completely asset-light model where we do long-term leases with our landlords. And as you know, we've announced a tie-up with FDM, which is France de Mer, which is the largest hotel REIT in France, having 20 billion under management. And it's assigned 400 million euros to build out hotels in partnership with us. And as of March of this year alone, we will have 8,700 beds. So this is a completely planned expansion. And when I talk about 15,000 beds, these are beds that are actually being constructed as we speak. So we're very positive on that. And the good news is that with Meininger, in spite of the setbacks politically and terrorism in Europe, has still seen a 90% plus. In fact, our occupancy rates are higher than they were last year. So it's proving to be an incredibly robust model.
Peter, thank you so much for your time today.